Thank you very much. It's great to have everybody along here this evening, and very much a warm welcome from the University of Strathclyde. I think this is the first time that we've had the Economic History Society here, and we've tried our best to pull out all the stops in relation to the next couple of days, including ordering in, obviously, a lot of sunshine for everybody. So very much hope the next few days goes well and you enjoy it. So tonight it gives me great pleasure to introduce our plenary speaker, Russell Napier. Russell originally hails from Donaghadee, County Down. He has worked in the investment business for over 30 years, advising global institutional investors since 1995, currently author of the Solid Ground Investment Report and co-founder of the investment research portal ERIC. So you might then ask, with a background like that, why have I asked Russell along to speak to a room of economic historians? Good question. Well, Russell is a proponent of financial history and the value that financial history can offer to investors today. So I think Russell's take on a variety of things will be quite interesting to people in this room. He is the author of 2 books, The Anatomy of the Bear, Lessons from Wall Street's 4 Great Bottoms, and The Asian Financial Crises, 1995 to 1998, The Birth of the Age of Debt. Russell holds honorary professorial titles at the University of Stirling and Heriot-Watt University. In addition to this, Russell founded the Library of Mistakes, a business and financial history library in Edinburgh. It's a free-to-access library where all are welcome and encouraged to come along and learn about business and financial history. Anyway, I don't want to steal any more of Russell's thunder. I suspect you're going to hear a lot more about this, so it just gives me great pleasure to hand over to Russell.
Well, thank you, Graham, and hopefully you can all hear me at the back. You'll see the title is Financial History, not Economic History. You might wonder why that is, because my day job is to advise institutional investors. And sadly, the only thing they're interested in is where the securities markets will be about 12 to 24 months forward. And if they were looking maybe 10 years forward, we could talk a lot of pure economics, productivity, et cetera, et cetera. But sadly, in the time frame they are prepared to contemplate, it's much more about finance, and it's much more about money and credit and the impact on asset prices. So if you find me droning on too much about money and credit, it's because that's what people want to buy. And my business is ultimately selling. So there is plenty in financial history about money and credit and monetary systems for us to learn about, and my job is to, if you like, teach the investment community about that because they are ignorant of it. And use the word ignorant is a big word, but you've got to remember that, well, I'm 60 years old now. Most of my clients are probably average 35, and they've all done degrees in economics or finance, and they're all masters of the spreadsheet. And they're all masters of the spreadsheet. So there is in our business a physics envy which has spread from economics to finance to investment, and I am being slightly unfair on my friends in the fund management community, but there's too much of that. And then what happened? Well, it wasn't just Donald Trump, but suddenly something else came along, and the discounted cash flow was no longer sufficient. And now there is a huge gap in the skill set for people untrained in maybe comparative economics, untrained in politics, untrained in sociology, untrained in philosophy, untrained in many of the things that are today setting security prices. So I've got good news for you. There's a huge demand for financial historians. So let me just talk a little bit about what I do. So this report I write goes to institutional investors all over the world. So yesterday I was speaking to 500 of them, all working for regulated financial institutions. And a lot of that was about financial history, but probably not what you're thinking. I guess most of you would think yesterday was a day to discuss Smoot Hawley. Why wouldn't yesterday be the day for that? And of course, maybe it is. But actually what we were discussing is the 1945 to 1979 period of financial repression, which I happen to think will be very useful in us determining the future level of security prices. But none of them know anything about it, because they certainly weren't born during it. They certainly didn't study it at university. And a plea I'll mention at the end, I don't think it's been well covered necessarily by academics. I think there's a great gap in the market when it comes to that, the way the financial system was run, primarily in Europe from 45 to 79. And of course, my bit is impact on security prices. So I'm in the business primarily of doing that. That's my day job. I would say everything else is what I would call missionary work, and missionary work to promote the use and understanding of more financial history. So in 2004, I set up the Practical History of Financial Markets course. It's on campus at the Edinburgh Business School as an elective, but we also run it as a little 2.5-day intensive version for the investment managers, and over 1,500 of them have taken that. And during COVID, we also created an online version of that. And that is a not-for-profit. It makes a profit, but it's a not-for-profit. And any profits that are made are distributed to other charitable ventures. And I'll mention some of those in a minute. So what is the core outline of that? Probably something you don't necessarily study in economic history, but it's the long-run valuation metrics for equities. We have data on valuation for equities going back to 1800, US dividend yield, and perhaps more famously for earnings, the so-called Shiller PE from 1881. So we look at which measures of valuation for equities have worked. What is the definition of work? Predict future returns. Now, they don't predict future returns over any reasonable time horizon, but over long-term time horizons, there are some measures of value that are useful, but not useful to anybody with a 1-year time horizon, which is the catch-22 of investment. So we then look at the mechanisms which we believe drive mean reversion of equity valuation, and the three we focus on are changing inflationary expectations, money, credit, and asset prices, and psychology. Psychology we do through a basic behavioral finance course. So that's the course as it exists. It sells well. There isn't exactly a queue to get in, but the demand is inversely correlated with the direction of the stock market. So we're expecting a flood of new students very, very soon. Nobody needs any education in financial history when the stock market's going up. Everybody's a genius when the stock market's going up, and suddenly when it's going down, everybody needs educated. So fingers crossed, business will pick up. As Graham mentioned, I've written this book, Anatomy of the Bear. I want to describe it really because to ask for your help. What I did back in 2004, roughly, when I was doing the research, you find the 4 times when the stock market bottoms and is cheap. Very easy way to define cheap. The returns after that are exceedingly high. That's a very practical definition of cheap. And then I read all the Wall Street journals 2 months before the bottom and 2 months after the bottom. So that is 4 months times 4. That's 16 months of Wall Street Journal, all in the most depressing periods of American history. And only a Calvinist could do that, really, but I enjoyed it. The reason that I bring it up is that I think it now fits, although this was 2005, with narrative economics, and I don't know how many of you have read Professor Shiller's book on narrative economics, which I think has got something going for it, and I think we can do more of that around securities markets. In other words, we want to look at the mood of the moment. By definition, everybody who was selling equities on these 4 occasions was wrong. They were dreadfully wrong. This was a fantastic time to buy. But the newspapers are full of people telling you why you want to sell. And the whole point of that book was to see were there repeatable patterns of people saying why to sell. Are there common errors that tell you when the stock market is cheap? It's not necessarily about the valuation, about money or credit. Is there a common psychological error at the bottom? And that's what I discovered. There are a series of those. Unfortunately, the book was published in 2005. And I did write a large report in March 2009 saying it's time to buy the stock market based on the research in the book. So after 2 years of research, it worked, which was more of a relief than anything else. But I think there's a lot of scope using the newspapers and using this searchable digital newspapers we have to look more carefully at those animal spirits, narrative economics, whatever you want to call it. And perhaps that's going on and I just haven't seen it, but I would be delighted to hear more about it if you know where that is happening. So the Library of Mistakes is a business and financial history library. So why is it called the Library of Mistakes? Because if we call it the Edinburgh Business and Financial History Library, nobody would turn up. So it is unashamedly attempting to popularize the study of financial history with a silly name, and it actually seems to be working. We get a lot of people coming to the library. We've got 2,500 people registered to come. We run regular lectures there where we have 80 or 90 people. Often, actually, we have a waiting list to get in for lectures on financial history. We don't just have one in Edinburgh. We have one in Lausanne in Switzerland. We have one in Pune in India. And at the end, I'll mention lots of other places that are about to get libraries of mistakes, including London and Singapore, but perhaps even more than that. So the question is, why? Now, why suddenly? We started in 2014. And I'll tell you why. There are a lot of people of my vintage in this industry. Obviously, they're fairly wealthy. They've been relatively successful, but they see the fallacy of the whole business. They see that the mathematization of the investment world has not been an unalloyed success, and they feel they want to do something about that. And what they might do about that is finance a library of mistakes. It may be a small step, a small penance, if you like, but people come to us. We don't go to them. I say us, we are a charity. This is financed by the operating business, and the operating business is the practical history of financial markets. So if you know one of those people and you would like a library of mistakes, outside the United Kingdom, we're effectively a franchise operation. People come to us with money and space, and we give them the name, and we give them the catalogue, we help them build the collection, and we're beginning to build this satellite, which is collecting material. Really excited about Singapore, because we really don't have a lot of Asian material in our library, and our joint venture partner in Singapore is the National Library of Singapore, so we'd be hopeful that they could do that, and then we could replicate that in Edinburgh. So we've become a collecting network. These lectures are all live streamed, all recorded, and therefore each library builds a base of financial history material. So that's the Library of Mistakes. I started that in 2014. It was opened in 2014 by a man called Lord Norman Lamont, or Lamont, if you're from these parts of the world. And he knew exactly why he'd been asked to open the Library of Mistakes. And he was very, he was a good sport, let's put it that way. We then opened again with a bigger premises in Edinburgh, and the late Lord Darling opened that as well. So we've had two chancellors of the Exchequer. We've had the former central bank governor of Iceland as well. So we're getting some quite high profile speakers. Okay, the second book is The Asian Financial Crisis. I will not talk about that in great detail, but I lived through that. I was in Hong Kong. I was a regional strategist. I was writing about this thing as it sort of unfolded. So I've written that up. And once again, using contemporaneous opinion about the future. All the people who thought we were living in an Asian economic miracle, and why they thought it was a miracle when it was a disaster, and then all the people who said it was a disaster when it was about to become a recovery. And once again, it's the difference in opinions which is reflected in the equity market. So the Library of Mistakes podcast, we launched that in 2022. It's in the top 2% of global podcasts. Before we get too excited, let me tell you what that means. But we do get 5,000 listeners to each episode. So I'll be asking you at the end if you'd like to come on the podcast and talk about financial history with a focus on money, credit, and asset prices. Just let me know, but actually it's a broader scope than that. So we have the podcast going on as well. I happen to do an annual lecture at Stirling, and for John and Will's Financial Bubbles and Crisis, I do a lecture on the Asian financial history. And then finally, it's not really financial history, but we just set up the market mind hypothesis at the Edinburgh Financial Institute, which is an attempt to get us away from this rational economic man thing, efficient markets hypothesis, which allows people to pretend that the economy and financial markets are a machine, when they clearly are not a machine, and they're more of an organism. And I think that is one of the takeaways from financial history. So that's where we've got to so far. So how do I use it? Well, first of all, the existing approach to finance has stripped out or distilled away certain things. Now, Scotland's very good at distilling, as you probably know, But I think finance is pretty bad at it, because what it's stripped out in terms of how my clients look at the world is there's no politics, there's no psychology, there's no sociology, and they are involved in this physics envy. And it was only rather belatedly that they're coming to realize that this stuff counts. Because I think one thing we all know, whether as historians, financial investors, or just plain citizens, is we're living through a massive structural change. And these things count in a structural change. And one of the beauties of studying financial history is it's all in there. I mean, it is possible just to go and do a degree in politics. But if you read financial history, you're getting it all in the one great big pot. So that is one of the reasons why I think there's a growing demand for it, a realization that we need to get that somewhere, and financial history may be the easiest way to get through it. Reflexivity is a theory of George Soros, one that has a lot of followers in financial markets, which says that the market is not reflecting the fundamentals, but the market often actually changes the fundamentals. And economists have been not very good at working out what that means and how to incorporate it in their analysis. But once again, if you read financial history, the history of markets, and equity markets in particular, you get some idea of this reflexivity, this relationship between rising prices and euphoria, and when that might come to an end. So that's something else that financial history can bring that actually traditional economics can't bring. I always say to people who come on my course, and this really upsets anybody under the age of 40. They say, I don't think we've got any of the right answers. You can see them rolling their eyes. And I said, I think we've got the right questions. Because in my experience, in 35 years of being in the business, 30 years of advising fund managers, they're very good at getting all the right answers to all the wrong questions. In fact, they're very pleased when they get a right answer. There's a personality type that just likes getting right answers and doesn't really care if they're to the wrong questions. And I think what financial history does is get us to better, let's say better questions. Right questions is probably too arrogant. It gets us to better questions. And then the beautiful thing about financial markets is you don't need the right answers. You just need a better answer than the guy beside you. And financial history, again, I think can help us get a better answer. And I think also it lengthens time horizons. Anybody who reads financial history realizes that you have to have a reasonably long time horizon if you're going to be investing. Whereas if you really believe this is all about discounted cash flow and spreadsheets, you can kind of believe that it can all happen, all the magic can happen over 12 months. So that's how I use it in terms of, if you like, sort of big picture philosophically. But practically, it's about more than that. The market is treated as a machine, and really it's an organism. And just imagine trying to analyze an animal as if it was a machine. You would be getting everything wrong. So what we're trying to do is move away from that. And then there's radical uncertainty. I'm sure you're familiar with it. I just picked a definition. I think this is from the LSE, actually. I thought it was a good definition of radical uncertainty, where we can neither imagine all possible outcomes nor assign probabilities to future events. So it's a non-calculable form of uncertainty, which we may well be living through. I mean, certainly it feels like we're living through it. And of course, it has profound impacts on the price of financial assets. And it says here, neither imagine. Well, maybe we can't imagine all possible outcomes. But if you're a reader of financial history, you have a better idea of some of the possible outcomes, and certainly a better idea than those unschooled in financial history. So perhaps better able to deal with radical uncertainty. The Duke of Wellington said that half the business of war, and indeed half the business of life, is knowing what's on the other side of the hill. And Mike Tyson put it slightly blunter, saying that everybody has a plan till they get punched in the mouth. If you read financial history, you have at least some idea of the range of punches in the mouth which could potentially be delivered. And for that alone, I think we need to look more at financial history, to look at that band of uncertainty that faces anybody. A lot of it's in technology, some of it's in politics, but if we assume away radical uncertainty, which is frankly what the profession has been doing for a long time, you can end up in a very dangerous place. Financial history helps us with that. So as I said, in terms of what I do, it's a lot of it on money and credit, because that is what drives asset prices over these ridiculously short-term timeframes. The impact of global monetary system, It is argued today there isn't one. Well, there absolutely is one. Sort of oscillates or has been revolving around the link between the Chinese exchange rate and the dollar and the management of that exchange rate, and I won't go into that. But if you know the history of monetary systems, global monetary systems, whether it's Bretton Woods, the gold standard, or whatever, you have a better idea of imbalances and where those imbalances might come from and how those imbalances might be unwound. And I can assure you those are not questions even today that are being asked, which seems bizarre. How money is made and destroyed is something that I would say 90% of fund managers don't know, which is quite shocking when you consider their job is to do with money. But when we look through the history books, obviously we find lots of dramatic incidences of money creation and money destruction, and the consequences of both. And if you study economics, pure economics, then you're not that familiar with the nitty-gritty of how money is created. We can go back to the former Queen of the United Kingdom for that, who went to the LSE or went to the Bank of England and said, "How come none of you saw it coming?" Well, quite a lot of financial historians did see it coming, but for those who didn't really understand money and credit and imbalances, then they didn't. It was mainly financial historians who saw it. I use it as well for looking at the history of the levels and composition of credit growth. There are two forms of credit growth: bank credit, non-bank credit. One creates money, one doesn't create money. One can lead to a form of imbalance in rising debt to GDP ratios, and we can look back at history for comparisons with where we are today, and that is also useful. As you can see, this isn't rocket science. It's not as if I've discovered something new. In fact, I'm looking at something very, very old, but it turns out it's something that other people are not at the minute looking at. We can look at the history of the deregulation of the financial system, which has happened quite a few times and tends to lead to sort of, let's just say, excesses. And if you see a deregulating financial system, you can be pretty sure there's going to be excesses somewhere, and that will help us narrow them down and make money out of it. And then exchange rate regimes. I was lucky enough to forecast the Asian financial crisis, and that was by looking at the imbalances around managed exchange rate regimes, which I can assure you nobody else was doing. So none of that means that I'm very good at any of this. It just means I'm asking different questions because I've read a bit of financial history, and the world is changing to ask these questions. So I'm not going to boast about my successes in forecasting, but don't worry, because the next slide is failures in forecasting. So what has it been able to help me with, and what has it not been able to help me with? So I mean, the kind of obvious one is the unsustainability of credit booms. The definition of a bull market is really, and I've got two experts sitting in the room here, I can see them, Turner and Quinn, it's in the book. There is a great credit expansion, but when you're living in the middle of that credit expansion, nobody seems to pay the blindest bit of notice to it and assumes that it can go on forever. So not only does it help us look to where that might be, because it's not always as visible as you might think it is in the data. For instance, in Asia, it turned out that a lot of that credit was dollar credit, offshore, and it was really unrecorded. So sometimes you have to look hard to find it, but it's there and it doesn't go on forever. I remember a banker, when I started in this business, a banker said to me when I was sitting trying to analyze his bank, he said, "Here's all you got to know about banking, son. If it grows like a weed, it is a weed." We forget that sometimes. I've mentioned the 2009 stock market bottom, which I was able to get right by looking at the commentariat, really, the commentariat, the great fear of deflation, which is the one thing that will really depress equity valuations, and then the realization that we weren't going to have that, particularly with the launch of quantitative easing. But the thing was seeing over and over again the same stories that I'd read in the 1921 Wall Street Journal or the 1932 Wall Street Journal about the collapse of the entire system. And it doesn't collapse. It doesn't collapse because the authorities have to stop it collapsing. And sometimes they're rather late, as they were in 1932 or 1933 with leaving the gold standard, but they kind of get there in the end. And when they get there in the end, they ward off the deflation, and equity, which is the fine sliver of hope between assets and liabilities, does pretty well when they ward off deflation. I was also right about the rebirth of inflation from 2020. That seemed to be particularly easy, as that was just based on the rapid growth in broad money. The government had guaranteed bank credit, so the bankers were on couldn't lose by lending money. When a bank lends money, it creates money, and it seemed so obvious that we would have inflation. And yet central bankers and investors refused to believe that this would happen. 40% of all the dollars ever created in history were created from 2020 to 2024. And yet we were supposed to have no inflation. So sometimes it looks pretty obvious, but the crowd wants to look the other way. So failures, it's exceedingly difficult to work out the top of a market. You probably know that, well, you all know this great quote from Keynes. The market can remain irrational for much longer than you can remain solvent, and he should know. Up until 1932, he was regularly teetering on the edge of bankruptcy because he was using a lot of leverage in his speculation. And then he was transformed into a value investor, and that went much better for him, and that's what we know him for. But I think there's a lot of great work could be done on irrational exuberance by looking at the press and during periods of rational exuberance, trying to find some patterns in there. I don't know enough about AI to know whether it could help you with that. But these are important periods. I mean, they're important periods for policymakers as well. The irrational exuberance phrase, you will know, was taken from Schiller and used by Greenspan in testimony, I think, 95, 96. Now, had Greenspan actually believed in it, he might have done something to perhaps curtail it, but he actually didn't. So if there was some way of actually working out when we'd gone beyond the range of the rational, that's probably a better way of putting it, into what is truly irrational, that might be exceedingly helpful for policymakers and investors and for society. And I think economic financial historians could help with that. It's been very difficult with policy responses. Sometimes you'll see things that seem completely unsustainable, but it is the joy of politicians to make sure that they are sustained at any price. And on that, I would mention the Chinese exchange rate, which seems to me to be a great weight around the neck of China and a great weight around the neck of its leadership. But one that for reasons of control perhaps aren't being fully expressed. I don't know what you see in financial history that helps you with when politicians recognize the reality. How much are they prepared to sacrifice to sustain an unreality? Seems to me a very, very difficult thing to get right. And then it's been, financial history I think has been, I would say, relatively useless with the euro. The euro seems like guaranteed to fail monetary experiment. I mean, it's got these massive differences in debt to GDP through the system, massive deficits in private sector services, debt service ratio, current accounts. It just seems that it shouldn't work. But like the bumblebee, it flies anyway. And it has a central bank that's prepared to do, in the words of its former central bank governor, Mario Draghi, whatever it takes. And if you have a central bank unfettered by politicians and frankly unfettered by its own constitution, then perhaps the whole thing can keep going much, much longer than any doomed monetary system ever could. Anyway, it's going, and the political will to sustain it is high. So all the analysis that said it was like this monetary union or a previous failed monetary union has so far proved to be pretty useless. Obviously, I could go on for a lot of time about the forecasting failures, but I put it up there in case you got the idea that I thought that financial history alone would help you get rich in financial markets, because it doesn't. It helps you maybe get better, but you're still going to make lots of mistakes. If it helps you to ask the right questions, it doesn't absolve you of the need to get the better answer. You might all ask the right question, but still not get a very good answer. So all we're doing is focusing on what counts. And what counts often is not what can be counted. And you'll recognize that as a quote theoretically from Einstein, but actually from a Canadian sociologist. So where is the future? And this is where hopefully you could help. So we have these libraries, free public access libraries in Edinburgh, Pune, and Lausanne. Singapore will be opening probably early next year inside the National Library of Singapore. So if you're in London or Singapore and you want to be involved, I'm not asking for any money. You'll be glad to know we've got all the money. If you want to be involved in any way, just let me know. If when we open you'd like to speak there, please let me know. If you could help us build our collection on Asian financial history, that would be fantastic, because it's currently rather Anglo-Saxon orientated. And we're in discussions for new libraries with donors in Mumbai, Toronto, Paris, Frankfurt, and Monaco. I don't know what charitable basis we might have in Monaco, but presumably there's somebody in Monaco, maybe one person who needs a free public library. But anyway, that discussion is underway. So if you're living in any of those jurisdictions and you think you can help in the ways that I've mentioned, please let me know. So we're always looking for guests on the podcast. So if you have any interesting papers, we're not a commercial organization. We're not trying to sell books. If you have a book, we'd love to talk about it, but we don't need a book. If you've got an interesting paper, I'll be happy to have a chat with you about that. We've got about 5,000 members of the public listening, which I think is incredible, because we're not aiming it at the stock markets going up and the stock markets going down. It's not that type of podcast. It's not, hey, buy crypto today and sell something else tomorrow. It is financial history, and yet we still have 5,000 people coming in. Also, my plea is I think there's a gap in the market for work on this period from 1939 to 79, and probably more the post-war period, on the financial repression brought in 39 that lingers and lingers throughout Europe, and how capital was allocated in that system, how banks were run through that system. And maybe it exists and I just don't know where it is. So if you know where it is, please come and let me know. I've got a lot of reading to do and catch up. There's a tremendous book by Eric Monet, previously of the Banque de France, called Controlling Credit, on the French banking system. But I think we're lacking on that, and I'm not sure that the investment management community is just realizing that they need this because they can see financial repression coming. But I'm not sure that academia has really caught on to just how big an opportunity there is in financial repression. It doesn't sound very sexy, does it? You know, I'm doing financial repression. Maybe that's why people aren't really doing it. And as I've already mentioned, I think there's also a gap for research on narrative economics. It would be remiss of me not to forecast the future, having told you that this is a great tool for forecasting the future. So here is America's non-financial debt to GDP ratio. So this is the government plus the household sector and the non-financial corporate sector. Non-financial corporates are excluded because the basis is they must be lending to the other three. Whether that's a good conclusion, I don't know, but anyway, this is it. The point of showing you this is that it's much higher than World War II. That at the end of World War II, we have a very indebted American state, but we have a very unindebted corporate and private sector. They had lived through a Great Depression. People don't have debt during deflation. And also they had lived through World War II, where there was a great mobilization of savings at the state level rather than the private level. So something will have to be done about this. And this, believe it or not, is one of the better numbers in the world. 253% of GDP. The United Kingdom, by the way, is about 240. Italy is about 240. Italy's got a very undergated private sector, but France is 321 with a very overgated private sector. Japan is about 390% of GDP. So there's this great range. And if you look at debt to GDP, you come to the conclusion that the least risky places in the world on that one metric alone are all emerging markets, ex-China. Really interesting that there is still a shadow of that Asian financial crisis, and it seems to be that people run coherent balance sheets. So my forecast is that is going to be significantly lower 10 to 15 years from now. And if you make that, because it's so dangerous where it is, because we're so unstable, and those are the things that you would bring it down. You're all economic historians, so I'm not going to tell you about those. But we have to work out as which one the politicians will choose of the austerity, default, real growth, hyperinflation, or repression. My own view is that real growth is not within the gift of the politicians. It's within the politicians can create a better playing field to try and stimulate it, but ultimately high productivity growth is within the gift of the innovation within the private sector, so we keep our fingers crossed and hope. But politicians, I think, will choose repression for the answer to that, which is not just about keeping inflation above interest rates, it's about actually having greater control over the allocation of resources within an economy, the allocation of financial resources, and it is with us as we speak. And if you want to learn a little bit more about it, I recommend a wonderful speech by President Macron, 26th of April last year, the Sorbonne. It's got the cheery title, Europe, It Can Die. And he explains that Europe will die unless President Macron takes the savings of the people of Europe and assigns them to the right places. I'm being a little bit facetious there, but he's saying that it is absurd, he says, that Europe sends 300 billion euros a year to America to invest in America. It is absurd. So that money's coming back. It's coming back, and it's coming back under government edict, in my opinion, and it will be allocated accordingly with good and bad results, no doubt. But that is not the world that my clients have lived in, nor is it the one they read about in their textbooks, in which people were free to choose. I obviously take that title from the book by Rose and Milton Friedman, but it's a very, very different world, and I think it'd be great if somebody could do a little bit more work on it. So I'm going to finish on this, and this is my kind of, not my rallying call for financial history and economic history, but this is from Angus Deaton, who you might know as a holder of what people refer to as the Nobel Prize in Economics. He made this speech last March at the IMF, and I think it's exceptionally important for everybody in this room and exceptionally encouraging. And why don't I just read it then? But the currently approved methods, randomized controlled trials, differences in differences, or regression discontinuity designs have the effect of focusing attention on local effects and away from potentially important but slow-acting mechanisms that operate with long and variable lags. Historians who understand about contingency and about multiple and multi-directional causality often do a better job than economists of identifying important mechanisms that are plausible, interesting, and worth thinking about, even if they do not meet the inferential standards of contemporary applied economics. So I've got good news for you. You're into bat. That's it. That's my trip, 30-year trip through financial history. Thank you.